EBIT, EBITDA, EBITDA. You've definitely seen this alphabet soup of finance terms everywhere, right? From company earnings reports to big news headlines. But what do they actually mean? And, maybe more importantly, what crucial details might they be hiding? Well, let's crack this code together.
Okay, just imagine for a second that you're an investor, and you've got a choice to make. You're looking at two companies, but on the surface, they are just worlds apart. So how in the world do you make a true apples-to-apples comparison of their actual performance?
Let's make this real. On one side, you have Heavy Machinery Incorporated. We're talking massive factories, tons of equipment that's constantly wearing out. And on the other side, you have Digital Solutions Company, a lean tech startup with super valuable patents, but almost no physical stuff. Their profits on paper could look completely different. So, where do you even begin?
Well, the very first step is to strip away all that noise so we can get right to the core of the business. And our first tool for that is a metric called EBIT.
EBIT. It stands for Earnings Before Interest and Taxes. Think of it as a company's pure, core, operational profit. It's designed to answer one simple question. If we totally ignore how a company is financed and what its tax situation looks like, how much money is it actually making from its main day-to-day business?
And that's exactly why EBITDA is so useful. It lets us compare Heavy Machinery Inc. and Digital Solutions Co. on a much more level playing field. We're focusing just on their business operations. But, and this is a big but, it is not the full story.
Because EBIT misses something pretty huge. Remember those factories and all those patents? They lose value over time. That is a very real cost, even if it's not cash walking out the door every single day. So how do we account for that?
This brings us to two really key ideas: depreciation and amortization. So depreciation, that's for the physical, tangible stuff, like the machines at Heavy Machinery Inc. that are wearing out. Amortization, on the other hand, is for the non-physical, intangible stuff, like the patents at Digital Solutions Co. that have a limited lifespan. Both of these are really important non-cash expenses that reduce a company's profit on paper.
And trying to account for these non-cash expenses brings us to the most famous metric of them all, EBITDA. You see this one everywhere, and believe me, it's popular for a reason.
EBITDA stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. The logic behind it goes something like this. Since depreciation and amortization aren't actual cash leaving the company right now, if we add them back to EBIT, we should get a much clearer picture of how much cash the company's operations are really generating.
And the calculation is pretty much exactly what it sounds like. You just take your EBIT, you add back that depreciation expense, and then you add back the amortization expense. What you get is a number that's supposed to scrub out all those accounting charges.
And with that, it really seems like we've found our magic number. EBITDA looks like the perfect tool to compare our machinery company and our tech startup on totally equal footing, right? Focusing only on their ability to generate cash. But there's a problem.
Yeah, unfortunately, EBITDA's immense popularity hides some pretty serious flaws. It can be a very attractive and often a very deceptive number.
And look, this is not a new concern. Way back in the year 2000, the credit rating agency Moody's was already warning people that EBITDA can be misleading. So, what's the real issue here?
Okay, here is the absolute heart of the problem. A positive EBITDA does not guarantee a company is actually generating cash. Why? Because it completely ignores the cash you need for day-to-day operations. That's your working capital. And even more critically, it ignores capital expenditures. We're talking about the actual cash a company has to spend to maintain and replace its assets.
And this really gets to the core of it. You know that depreciation we just added back? It's not just some accounting trick. It's often a really good estimate of the actual cash a company will have to spend just to stay in business. So by ignoring it, EBITDA can paint a much rosier picture than reality.
So if EBIT is a little too simple and EBITDA can be pretty misleading, is there a middle ground? Yes, there is. Let's take a look at the lesser-known sibling, EBITDA. EBITDA stands for Earnings Before Interest, Taxes, and Amortization. Notice what's missing there?
Yep, depreciation. See, EBITDA adds back both depreciation and amortization, which means it basically ignores the cost of keeping your physical stuff running. EBITDA is different. It only adds back amortization. And this is a huge distinction because it acknowledges that depreciation represents a very real recurring cost. It treats the wear and tear on your machines as a true expense, but it treats the write-down of a patent as something different. So, after all that, where does that leave us? Well, I think it's pretty clear by now that there is no single magic number when it comes to profitability. Let's just break it down one last time. You have EBIT, which shows you that core profit but ignores those non-cash costs. Then you've got EBITDA, which is that middle ground, treating depreciation as a real expense, but it still misses things. And then there's EBITDA. While it's super popular as a stand-in for cash flow, it's the one that's most likely to overstate a company's financial health, because it ignores the very real cost of keeping things running.
Ultimately, you have to remember that each of these metrics is just a different lens, and no single one shows you the whole picture. The real skill isn't just memorizing definitions, it's understanding what each lens focuses on, and, just as importantly, what it leaves out of the frame.
So I'll leave you with this question. The next time you see a headline celebrating a company's record EBITDA, what are you going to ask? Are you going to ask about their capital expenditures? About their working capital? Because knowing the right questions to ask, that is the real key to cracking the code.